You feel it every time you open the app. The numbers move, the market does something, and your gut tells you that you should be doing something about it. Buy this, sell that, rotate out of the thing that dropped. Everyone around you seems to be moving, adjusting, optimizing, and you're sitting there wondering why your account isn't growing the way there seemed to be. You feel a step behind. You feel like the person who didn't get the memo. At least that's the story you've been telling yourself. Here's what I want you to consider before this is over. The person you think is winning, the one who trades on the dips, who has opinions about every earnings report, who always seems busy with their money, is very often the one quietly falling behind. And the person who looks like they're doing nothing, who barely checks, who makes one boring move and walks away, is the one actually building something. Stay with me, because the reason isn't laziness, and it isn't luck. It's a piece of math that almost nobody feels in their body until someone spells it out. Let me tell you about a man named Darnell. Darnell was 41 when he showed me his accounts, and he was exhausted. Not physically, financially exhausted. The specific tiredness of a person who has been paying attention to money constantly for years and has almost nothing to show for the attention. He made about $90,000 a year as a regional sales manager. He read the finance forums. He had 3 brokerage apps on his phone. Over the previous 4 years he had made, by his own count, more than 200 separate trades. He knew the tickers. He knew the stories. And when we added it all up, his portfolio had returned roughly 2% a year over a stretch where simply holding the broad market would have returned close to 11. Read that again slowly. He worked harder at his money than almost anyone I knew, and the work cost him money. The gap between 2% and 11% doesn't sound violent when you say it out loud. It sounds like a rounding error, like the kind of thing that sorts itself out. It does not sort itself out. On the balance he was managing, that gap was the difference between a comfortable retirement and working until his body gave out. He wasn't undisciplined. He wasn't dumb. He was doing exactly what the entire environment around him was engineered to make him do, which is confuse motion with progress. That's the thing I need you to sit with. The activity that feels like responsibility is often the exact thing draining the account. There's a word I want to give you, and I'm going to hold off on fully defining it for a minute because I want you to feel it before you understand it. The word is friction. In the world of money, friction is every point at which your attention touches your portfolio and leaves a mark. Every trade has a cost, even when the app says commission-free. Every decision to buy or sell is a decision that can be wrong. Every time you look and feel something and act on the feeling, you introduce a tiny tax, sometimes in fees, sometimes in taxes, and most expensively in bad timing. Friction is invisible in the moment. It only shows up in the total, years later, as the difference between what you earned and what you kept. Now watch what that does over time. The people who build real wealth in the market are not, for the most part, the people making the smartest individual moves. They're the people making the fewest moves that can go wrong. And this runs so hard against everything we're taught that it feels almost irresponsible to say out loud. We're raised to believe effort and reward are linked. Work harder, earn more, pay closer attention, do better. In almost every part of life that holds. In investing, past a very low bar, it inverts. Past the point of setting things up correctly, additional effort tends to subtract. Here's the part everyone misses. It has almost nothing to do with intelligence. Darnell was smart. It's a structural problem, and structural problems are invisible until someone points at them. The structure is this: the market rewards ownership over long periods, and ownership requires you to do the one thing that is psychologically hardest, which is nothing, through the stretches when doing nothing feels insane. Let me show you the machinery underneath, because once you see it you can't unsee it. Imagine 2 people, same income, same starting point. Both put $500 a month into the market. The first one, call her Priya, picks a broad, low-cost index fund, sets the contribution to automatic, and then, this is the whole trick, forgets about it. She doesn't check daily. When the market falls 30%, she doesn't see it for weeks, and by the time she does, she's already bought more at the lower price without having to be brave, because the automation was braver than she could be. The second one, call him Marcus, does everything Priya does except he pays attention. He moves money around. He sells when he's scared and buys when he's excited, which means he sells low and buys high, gently, repeatedly, almost imperceptibly, for 30 years. Run that forward. $500 a month at roughly 8%, left completely alone, becomes something in the neighborhood of $700,000 over 30 years. That's Priya. Marcus, shaving 2 or 3% off his return every year through friction and fear, lands closer to $400,000. Same income, same contributions, same 3 decades. The difference, $300,000, was not earned by Priya. It was simply not lost. She kept it by refusing to touch it. $300,000. Or doing less. That number is the whole video, really, but I need you to understand why it's so hard to capture, because if it were easy everyone would have it. The difficulty is not financial, it's emotional. Doing nothing while your account drops is one of the most uncomfortable experiences a modern person can have, and the discomfort is manufactured. It is fed to you, deliberately, all day long. Think about where you actually encounter your money. You encounter it on a screen, inside an app, and that app was designed by people whose job is to maximize how often you open it. The red numbers, the notifications, the little charts that update in real time, none of that exists to make you wealthier. It exists to make you engaged. And engagement, in investing, is the enemy. You are being nudged, hour by hour, toward the exact behavior that quietly transfers your future wealth to fees, to taxes, and to the people on the other side of your panicked trades. You are not weak for feeling the pull. The pull is engineered. Naming it is how you start to diffuse it. Let me tell you about Elena, because she's the counterpoint, and her story is almost boring, which is the point. Elena was a nurse, 52, and when she came to see me she apologized before she even sat down. She said she felt embarrassed because she didn't really do anything with her money. She'd set up an automatic transfer into a retirement account in her early 30s, picked a target date fund because she didn't understand the other options and that one seemed to handle itself, and then for 20 years she'd mostly ignored it. She raised 2 kids. She worked doubles. She did not raid finance forums. She could not have told you what the market did last quarter. And she was sitting on just under $600,000, on a nurse's salary, entirely by accident of temperament. She thought she'd failed at investing because she never learned to do it actively. She had, in fact, done it almost perfectly. The not learning was the strategy, even though she never chose it as one. Her boredom protected her. Her lack of confidence kept her from the moves that would have hurt her. She looked, by every cultural measure, like someone who wasn't serious about money. She was quietly out-earning nearly everyone I knew who was. Sit with the unfairness of that for a second, because it's important. The person who tried hardest, Darnell, lost. The person who barely tried, Elena, won. That's not a moral failing in Darnell or a virtue in Elena. It's the shape of the game itself. The game punishes the instinct it also provokes. Now, I can feel the objection forming, because I've heard it 100 times. Surely someone paying attention can beat someone who isn't. Surely skill matters. And here's the honest answer. At the level of professionals with teams and data and infrastructure, occasionally, barely, and less often than you'd think. But you are not competing at that level, and neither was I. For ordinary people investing ordinary paychecks, the attempt to be clever is, overwhelmingly, the thing that costs the money. The research on this is not subtle and not new. Investors, as a group, earn meaningfully less than the very funds they invest in, because they buy and sell at the wrong times. The fund goes up, the investor, moving in and out, captures only part of the ride and eats the losses in between. The gap between the fund's return and the investor's return has a name in the industry, and it exists precisely because people cannot leave things alone. Here's where it gets stranger. The single move I'm describing, pick a broad, cheap fund, automate the buying, and then genuinely stop touching it, looks so passive, so lazy, so much like giving up, that people resist it emotionally even when they understand it intellectually. It doesn't feel like a strategy. It feels like negligence. We've been trained so thoroughly to equate effort with virtue that a strategy built on restraint reads as a strategy built on not caring. But restraint is not the absence of effort. Restraint is the hardest effort there is. Think about what Elena actually did across those 20 years, even though it looked like nothing. Every time the market crashed, and it crashed several times in her window, she didn't sell. Every time a coworker bragged about a stock that tripled, she didn't chase it. Every time a headline screamed that this time was different, she didn't flinch, mostly because she wasn't looking, and the not looking was itself a kind of discipline she'd accidentally engineered by setting things up and walking away. What reads as laziness from the outside is, on the inside, 1,000 tiny acts of not flinching. She just automated the not flinching so she never had to feel it. That's the secret hiding inside the lazy move. You are not trying to become a person with superhuman discipline. You are trying to build a system that doesn't require it. You remove your own hands from the wheel, on purpose, because you already know your hands will shake. Let me put a finer point on the cost of the shaking, because I don't think most people have ever seen it laid out plainly. Say you're 35, and you've got $50,000 invested, and you add $400 a month. Leave it completely alone at 8% until you're 65. You land somewhere around $800,000. Now run the same numbers but assume that you're fiddling, the trading, the fear selling, the fees, the taxes from moving in and out, costs you just 2% a year. Not a disaster. Not blowing up your account. Just a quiet, steady 2% of friction. At 6% instead of 8%, that same setup lands closer to $480,000. The friction, the activity, the sense of doing something, Cost you over $300,000. It bought you nothing except the feeling of being busy. Read that again. The feeling of being busy, priced out over 30 years, cost more than most people's houses. And this is the part that reframes everything. So let me say it as plainly as I can. When you see someone who seems intensely engaged with their money, the trades, the opinions, the constant repositioning, you are not necessarily looking at someone who is ahead. Very often you are watching someone pay, in real time, for the privilege of feeling in control. The activity is the price. The calm, boring person who set one thing up and left is not behind them. In the numbers that will actually exist in 30 years, that boring person is very likely to be far, far ahead. If this is landing, take a second and subscribe. This channel breaks down the real numbers behind the money moves nobody explains honestly. Now, the next part is the one that separates the people who talk about money from the ones who quietly end up with it. Because here's the deepest version of the idea. And it goes beyond investing into something almost philosophical about how wealth actually forms. Real wealth is not built in the moments of action. It's built in the years of inaction between the actions. The one good decision, start early, buy broadly, automate it, leave it, is made once. Everything valuable that happens afterward happens while you are asleep, while you are working, while you are raising kids and forgetting the account exists. The compounding does not need you. That's the beautiful and slightly insulting truth of it. Once you've set the machine correctly, your involvement can only hurt. Your job, after setup, is to get out of the way of your own money. Let me tell you about one more person, because he changed how I think about this entirely. His name was Theo. And Theo was a house painter who never made more than $55,000 in any year of his life. No inheritance, no windfall. When he retired, he had over $1 million. I asked him how, expecting some clever story, and he shrugged and said he'd put 10% into the same fund every single time he got paid since he was 26. And that he'd only ever looked at the balance a handful of times because looking made him nervous and nervous made him want to do something, and he'd learned, early, that doing something was how you lost. He said it like it was obvious. To him it was. Theo out-earned doctors, not because he knew more, he knew almost nothing about markets, and was proud of it, but because he had removed himself from the equation so completely that his money could do the one thing money does best, which is grow untouched over a very long time. He didn't beat the market, he simply refused to lose to himself. And refusing to lose to yourself, it turns out, is most of the game. Once you see this clearly, the whole social picture rearranges itself. The friend who's always talking about his positions, who seems so much more sophisticated than you, who makes you feel behind for just holding a boring fund, you can stop feeling behind. You may well be ahead of him and neither of you knows it yet. And the version of you that felt lazy for not doing more, for not optimizing, for not having opinions about the market, that version of you can finally relax, because the not doing was never the failure. The not doing, done deliberately, is the entire skill. So what does the deliberate version actually look like, concretely, so you can walk away and build it? Start with one honest question. Before you ever move $1 into anything clever, do you actually need to do this? Or do you just need to feel like you're doing something? That question alone will stop most of the damage before it starts. Then automate. Set a fixed amount to move from your paycheck into a broad, low-cost index fund on the same day every month, and make it automatic so that no feeling ever gets a vote. The automation is not a convenience. It's armor. It stands between your future and your own nervous system. Then mute the noise. Turn off the notifications. Take the apps off your home screen. You are not missing anything by not watching. The watching was never the point, and the watching is where the losses live. If you check your long-term money once a quarter, you are checking it too often. Keep the cash you might actually need soon somewhere calm and separate, in a high-yield savings account earning real interest, so that a short-term emergency never forces you to sell your long-term investments at the worst possible moment. Protecting the long-term money from your short-term life is half of doing this well. And judge yourself, if you must judge yourself at all, on your trajectory rather than your position. Where you are today matters far less than the direction and the consistency. A small amount, invested relentlessly and left alone, beats a large amount managed anxiously almost every time. The person who invests $200 a month for 30 years and never flinches will very often finish ahead of the person who invests far more but keeps grabbing the wheel. If this way of seeing money is useful to you, the natural next thing to watch is the video I made on building the financial foundation underneath all of this, the boring, unglamorous base of emergency savings and debt that makes the calm possible in the first place. Restraint is a lot easier when you're not scared, and that video is about how to stop being scared. But before you go, come back with me to the beginning. You're opening the app. The numbers are moving. Your gut is telling you to do something, that everyone else is moving and you're standing still and falling behind. Feel that pull one more time. and now feel what's underneath it. The pull is not information. The pull is friction, dressed up as responsibility, engineered to separate you from the one thing that will actually make you wealthy, which is time spent doing nothing, while a good decision you already made quietly compounds in the dark. The person doing the most is usually paying the most. The person who looks lazy set the machine and walked away. And 30 years from now, when the numbers are finally in, the boring one is the one holding the fortune. Close the app. That was the move.